Hey, good morning, everyone. Welcome to the Macro Snapshot. We are Wednesday, May the 20th, 2026. Fairly sort of quiet overnight session. I'd characterize it as sort of a consolidation. The market yesterday had a little bit of sort of equity weakness, and probably most importantly, we had the yields in the US. We had a pretty nasty sort of a sell-off in the bonds, which caused the yields to rise a little bit more. So just quickly going through those, you see the two-year yield here up to 4.15%. The 5-year also up, and then the important benchmarks of the 10-year you see getting up to almost to 4.7%, so 4.6. So you can see here overnight just sort of calming down a little bit, which will be welcome news. But they're still very, very elevated, still above sort of this longer term downward sloping trend line. So the yield's still breaking out. And then we also have the 30-year, which, as I thought, would get to about 5.15, 5.16%. So the question is, can this continue? And really, it's going to be dependent on what happens in the energy complex and the whole sort of situation. So it's difficult. Can this be a bit of a blow off top and go a bit further to the upside? I think that's possible. But the reality also is that a couple of things here. First of all, geopolitically, any sort of relatively smooth and quick resolution of the issues in Iran could cause the oil to come down, gasoline to come down, and that whole sort of bottleneck in the supply chain sort of calm down a little bit, and that would be good for bonds, which would cause the yields to come down. So the thing is that way from these yields coming down significantly, will they remain relatively elevated? Yes, but maybe not too much to destroy sort of equity. So really, that's the issue here. The second thing, which is also important, is that once you start getting 30-year yields above 5%, and especially, crawling up towards the 5.5% level, the reality is that that becomes quite attractive for sort of pension funds, institutions, life insurers. All of the big institutions will start piling in, probably, as we start to get even a little bit higher. So the thing to keep in mind with the bonds is that it is a self-correcting mechanism, and at a certain point, these high yields do become relatively attractive. And the second thing as well is the third thing as well is that as these bond yields go up, they do lead to a little bit of a sort of implicit tightening in the overall sort of financial conditions. And of course, that brings with it, a potential slowdown in economic activity, which will then lead to a whole chain of events, which will, lead to the yields coming down anyway. So the point is that this is not necessarily going to continue going up to, 6, 7, 8%, as some more extreme commentators have said. And I think that, could it go a little bit higher if we continue to see oil moving higher? Yes, but I think that also politically is going to be very, very unpalatable. And we could also find a situation that, keep in mind that the US Treasury, Besant, when he first came in, said that he wanted sort of a bond yields on the 10-year at 3%, if you remember the famous 333s. And unfortunately, that the 10-year bond yield from Besant's position and point of view and Trump's point of view at 4.7, we're a long way north of 3%. So my point being is that, if the US Treasury wants to, it can come in here and start sort of buying long-term bonds. It could do twist operations. It can sort of boost up it could do buybacks of sort of the longer dated runs. It can also sort of issue a greater percentage of front-term bonds. So the point is here is that the US Treasury also, from a political point of view, if pressure comes from the White House, can also put upward pressure on those prices and downward pressure on the yields. So the thing is here is that it's going to start being sort of maybe potentially even sort of tempting to start thinking about some kind of reversals soon, and maybe like sort of long calls on TLT, something like that could be interesting. And just from a technical perspective here, if we look at some sort of indicators here, you can see here that there's some of the indicators I use. It's already calling for a reversal indicator. And this is a combination of stochastics, momentum, all kinds of things. So the momentum indicator here is still indicating sort of upward momentum clearly. But the other point which I want to just keep in mind here is that it's also a reversal. So we have reversal candle here, but also these yellow ones generally indicate the possibility of overextension. And we can see here in the Bollinger Bands, the 30-year yield here well above the upper extending outwards of the Bollinger Bands on the dailies. And you can see here that generally in sort of a recent history, so to speak, anytime that 30-year yield has extended above the 1 day, the Bollinger Bands on on the daily charts, that generally we've had a bit of a sell-off. You can see here, sort of back here in sort of beginning of May. You can also see here we had a pretty aggressive extension on the 21st of January, et cetera, et cetera. So the point is here, we're getting very overextended, and already we're seeing a little bit of give back in those bond yields. It wouldn't surprise me if we come back a little bit more, maybe to the middle of the Bollinger Bands, or even down to test this, sort of 5% level. Now, the point is that that's going to be important for a lot of reasons. Why is that? Well, clearly, the yields. The yields are causing well, what is it causing? It's causing the US dollar to be obviously sort of very well bid. We're seeing the US dollar also coming down. So I won't go into all of the currencies, but the US dollar, if those yields come down a little bit, that could put a bit of downward pressure on the US dollar, although it is acting as a safe haven. We can also see that the equities yesterday had a little bit of a sort of a sell-off. And also gaining a little bit this morning. So the bond yields are very important. Now, I just want to show you just in terms of something like gold. Let's just look at gold as well. Let's have a look here. But I just want to show you some of the correlations. Just found an interesting chart here this morning, courtesy of Ole Hansen here. And just to look at the correlations with gold. And you really see that gold at the moment, those longer term sort of factors such as, fiscal dominance, and whatnot are really playing second fiddle. And really what we're seeing here is, look at these inverse correlations to the 5-year US bond yield. You can see here the anti-correlated about at 0.81, so very, very high. So it means as the yields are going higher, the gold is not liking that. You can also see that as the dollar is going higher, the gold is not liking that. You see the correlation here also at negative 82 in terms of the dollar index. And then if you also see Brent crude, which of course is feeding into higher inflation expectations and higher energy prices and higher inflation in general, you can see that the inverse correlations at about 71. So the point is here is that this is what gold is really sort of reacting to. And so in order for gold and silver and the metals in general to find a bit of a basing formation here, we're going to have to see the bond yields come down, which should bring down the price of the US dollar. And also, of course, a lot of that the catalyst for that will be probably less expensive oil. So let's just go through a few charts here and just see if that indeed is the case. And that's what we are seeing overnight. We're just seeing a general sort of consolidation. So let's just keep with the precious metals here. You can see that gold here getting down to what I think is going to be a pretty attractive entry level for certainly the medium and long-term buys here. You can see the 200-day EMA, which also there's a big sort of horizontal support level at around about 44.40 or so. And already we're starting to see just a little bit of support there. Also, if we have a look at just a short-term fib here, let's look at a short-term fib. We'll just put it on this most recent impulse here. You can see that that's somewhere between the 50 and the 61.8%. So I think really that 61.8% is the 200-day EMA. It's also horizontal support. So a very big, strong support level there at 44, as I say, 25, 44, 30. Already a few buyers coming in. But again, in order for that to hold and push higher, we will have to see oil prices and energy prices coming down. Therefore, the US dollar coming down, yields coming down. That's going to give a bit of support. But if we do see that, and certainly any kind of resolution in the Iranian US-Israel conflict, I think gold could have a very significant bounce from these levels. It's starting to look attractive, and maybe it's time to sort of start dabbling with some smaller positions there. Similar kind of situation in silver. Silver has been selling off, but again, just throw a quick Fibonacci on it. Not exactly the same technicals here as gold, but basically what we can see here is that we are getting to that sort of level where there is significant horizontal support, around about $72.5, which also coincides not this time with the 200-day moving average, but with the 61.8 fib retracement level there. So, and also the recent low. So again, silver starting to look pretty attractive around about the $72.5 mark. If we look at copper, similar situation here, came in basically the bulls, as I was saying yesterday, they came in on this sort of fib here. So again, softer US dollar, lower yields, that's always going to be good for also the industrial metals. And we can see here that copper, you see here just on this fib there, looks like support came in almost exactly on the 61.8% fib retracement at 6.159 there. So again, if we do continue to see some softness in the yields and the US dollar and the energy complex coming down a little bit, we could see a bit more sort of upside today, not only on the precious but also the industrial metals. In terms of just the energy, which is leading, we had some significant drawdowns yesterday afternoon in the API in the sort of the private surveys. I'll just grab some tea for US inventory. We had crude oil a drawdown of a draw of 9 million barrels, which is much more than expected. We expected about -3. We got about -9 million barrels. We also saw Cushing drawing down over 1 million barrels, and we saw gasoline drawing down -5.8 million barrels. So the point is that the US is really exporting a lot. It's one of the only areas in the world where there's significant supplies of energy, crude, and so that's really drawing down a lot exports, not only for domestic consumption. So we're going to get this morning the official sort of a US government DOA Department of Energy numbers at normally at 10:30 on a Wednesday morning. So let's see if that confirms what the API numbers were, and that's indicating significant drawdowns. Now, of course, that's going to keep oil supported. We did see a little bit of softness, but basically oil still, WTI here, the front contract, still trading, over $100 here, just $102.50. And so, even if oil comes down a little bit, the reality is we're still at pretty elevated prices. Similar situation, gasoline. It did have a bit of a sort of a doji blow-off candlestick here on the top. But again, just consolidating. This is certainly no sort of a permanent sort of damage done to the charts and looking very strong. Now, we saw that the yields have stabilized. We saw the US dollars showing a little bit of softness. What we do see as well, just looking at the VIX, just looking at our volatility, volatility is remaining at about 18, so not down at low levels in the low teens, but down from the sort of the 2021 level, which we saw, let's say, like a month ago or so, but still relatively elevated, but not enough, I'd suggest, to impact the equities too much. What is a bit concerning is that the MOVE index has had a couple of updates. So that, of course, is bond volatility. And as I've been saying for a few days, equities don't mind yields grinding higher because of stronger economic growth. What they don't like is yields sort of spiking aggressively and with a lot of volatility. So it's going to be interesting today. Let's keep an eye on the MOVE index. If the MOVE index comes down a little bit, that could be a sort of a bit of a tailwind for the equities. And the equities, they had a bit of a sort of a sell-off yesterday. Again, just from a technical perspective, even on the shorter term fib here, which I measured from this one, the 29th of April, you can see here that, we just breached down into we're not even at the 20-day moving average, and we're just sort of caressing the 38% fib retracement here. So depending on NVIDIA, obviously we get in NVIDIA today, we also get Target. We had Home Depot, and so we're getting a lot of the big box retailers and Walmart. So depending on how all of those sort of shake out, and NVIDIA, which I'll talk about in a second here, there's no reason why equities can't have a little bit of a bounce as long as yields stay low, as long as yields stay contained and even diminish a little bit, which in turn, of course, will depend on the oil price. So that's where we are. If we also look at NASDAQ, had a little bit of sell-off, but again, you can see that just on that 38% fib level, about 28,700 on that shorter term one, was starting to bounce a little bit. So doing quite well, all things considered, with these sort of higher yields. So one thing which will get the market's attention, we do have the before NVIDIA, which is normally after the bell, 4:30, something like that. We do have the FOMC minutes from the last meeting. That was Jerome Powell's last meeting as Fed chair. And essentially, that's expected to be pretty hawkish. So really what the market will be looking at those 2 p.m. At that 2 p.m. release for the FOMC minutes will just be how hawkish. Were there more people than we expected on the committee who were pushing actively for sort of cuts? Or was it really just a question more of, hey, let's just sort of have stability and not sort of cut and not hike at this point? Sorry, did I just say looking for cuts? Looking for hikes. That's why we want to see if there's any evidence that we're sort of active pushing for any kind of hike. So that's expected to be hawkish. So that would require an extremely hawkish sort of FOMC minutes to move the dial. Although that hawkishness should just remind the market that the Fed is in no mood to cut anytime soon. So that won't be a support to the equity market. And there could even be, 2, 3, 4, 5 members of the committee who are actively looking to hike if the inflation scare doesn't go away anytime soon. So let's keep an eye out for that. Also, as I said, we'll be looking out for the oil inventories just to see if they're being drawn down to a worrying level at 10:30. Gold we looked at. Then, of course, we have NVIDIA. So let's just have a look and just look at the NVIDIA chart here, just while we're at it. just to see where we're at. So Nvidia, just from a technical perspective here, obviously is doing very, very well. If we look at just a couple of technical things here, we can see that there was like the Fibonacci extension in terms of sort of the measured move. You can see here, it didn't do the complete measured move, which would be up to about $245 or so. It got to let's say the middle one, the 0.786 extension, and we're having a bit of a sell-off. But if we actually look at this sell-off, you say, well, was this just a bit of sort of consolidation? Maybe that's a good way of looking at it, because if we look at just let's say this most recent sort of action here, you can see here that we just got down to the 38% fib level here, which is about $220 or so, just a little bit below that, 218, 220 or so. So at this point, there's no real technical damage. You can see here all the moving averages very much above the moving averages. If we look at let's say some of the Bollinger Bands, just to put those on, we can also see that it extended above the Bollinger Bands on the dailies. And generally, as you can see here, Nvidia, once it gets to the top of the Bollinger Bands here, just generally tends to pull back. You can see here, sort of here, here. So the fact that it did overextend, there could be just a little bit of a technical sort of consolidation, profit taking, whatever we want to call that there. So I wouldn't necessarily be looking too much sort of into this sort of recent sell-off. Now, so let me just, I'm trying to get rid of some of these Bollinger Bands here, remove. There we go. Okay, so the other thing I just want to look at here is just what is the market expecting. So let's just look at some sort of technicals. And what I just did some snapshots from the option chain. Now, I have to say, I didn't do these at 4 p.m. There was a bit of a run up yesterday afternoon. So these are not perfect because I did these at about, I think about 12 or 1 o'clock yesterday. But you can see here, the at the money implied vol is 83%. So pretty elevated. And you can see here, just in terms of what that means, what I have here is the option for Nvidia, which is expiring on May the 22nd, so basically Friday. And you can see here that the implied volatility, you're paying a lot of money for that, which is typical, obviously, for earnings. Very, very high, very expensive implied vol, around about 79% for the May 22. And it just as by way of comparison, comparing that to the basic June and July expiries, which are more in the 45, 43 range. So this is sort of the typical monthly expiry. So you're definitely paying a lot for that. And there will be some volatility crush. The implied vol will come down. And that, of course, makes the straddles, well, actually, let's just look at the skew here. A similar kind of thing you can see for the option expiring this Friday for Nvidia. You can see here very elevated skews also for the calls. You see the call side, a lot of upside here. So you can see typically the skews for Nvidia, you're looking at this kind of sort of curve, but you can see here for the May 22nd, which covers this afternoon's earnings, you can see, especially on the call side, very, very aggressive. So a lot of call buying here. And you can say, well, where are all the calls and the strikes? If you look at the open interest just for the May the 22nd sort of option, interesting to see that pretty heavy. So you're looking first of all at the calls. You see a lot of activity up here at about the 235 and at about the 240 levels. You can see a lot here. For the puts, you can see just sort of for the downside here around about the $200 mark. So these are the different strikes to be looking at there. If we just look at the cost of the straddle, you can see the cost of the straddle here is about $13. So you can see here the at the money implied vol yesterday early afternoon was about 83%, as I say, and the cost there, it might even be a little bit more now because Nvidia's gone up a little bit, but you're looking at about 13, let's call it about $14. So for a straddle. So if we look at what the market is expecting as a move in terms of percentages, we can just put that on there. And if we just draw out, let's say that, you can see that the pre-market here, we're looking, it's gone a little bit higher, 223. So you can see that, the market is looking, what do we say, it was about almost $14, around about 6% or so. So the market is looking for a move up to potentially those recent highs. That's on the upside. And if we look on the downside, you can see the market, as I say, looking at the straddle pricing around about, for $14 or 15% or so, is looking for something around about the 210 or so. So that's what the market is expecting. Of course, we're going to be very interested just to see in terms of, I would say the market is expecting a hot number, a very strong number. There's going to be a lot of interest just to see the revenue from China. And I just pulled this sort of chart, percent of revenue from China. And you can see here that obviously that has gone down back in 2022. That was almost at about 25% or so. You can see that it's now gone down to about 5%. And, obviously Jensen Huang was on the recent meeting or recent trip to China with Trump. And there's some talk that, he tried to be upbeat yesterday in a conference saying that he expected a little bit more sort of access to the Chinese markets. It seems as though the H200, the most sophisticated chips, could be sold into China, but they're still waiting for certification from China. And of course, other sort of Chinese competitors, because of the lack of those chips in the Chinese marketplace, have actually caught up a little bit and are pushing ahead. So there are still some concerns about sort of the Chinese market. And also, we just want to see what's happening with the hyperscalers. So in the hyperscalers here, you've got Amazon, Alphabet, Meta, Microsoft, and Oracle still forecasted to be spending a lot of money in 2027. That curve still seems to be going upwards. So let's look out for the commentary from Nvidia and just see, the profit margins, the hyperscalers, China. And, so can they beat? For sure, it's becoming more and more difficult to keep the market impressed. But, this is a very powerful company doing very, very well. Let's see how it goes. And as I say, let's keep an eye also just on the charts and whether it can get up to those all-time highs. Okay, guys, I'll leave it there for today. Let's watch out for Nvidia. I want to look at the oil inventories, obviously, just to see how the bond market reacts this morning. Will the bond market continue to sort of ramp up a little bit and have a little bit of a sort of a recovery? Keep an eye on the TLTs, the ETF for the long-term bonds could be an interesting one to be invested in sort of medium term. And obviously any headlines out of sort of Iran will be interesting apart from the Nvidia earnings. Have a great day, guys. I'll be back tomorrow with the macro snapshot from the macro shop. Thank you. Goodbye.